Good morning and welcome to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Weekly for Saturday, January 11th, 2020. This week, I sit down with LinkedIn's Devin Banerjee to discuss recent news about lower wage workers receiving an increase. Let's take a look.
Yeah, that's right. In the last segment, we talked about the cost side of things. Here on the income side, some good data for that lower earning, those lower paid workers here in the U.S. who have not really seen the wage growth that the upper bucket has seen in the past few years. The Federal Reserve Bank of Atlanta, some new data showing that lower paid bucket of workers is actually seeing wages grow by about 4.5% last month. And that contrasts with about 2.9% for the upper bucket. So we're finally seeing those lower paid workers seeing their wages rise actually faster than their bosses in many cases. And this is, as we've talked about, really a sign of how strong and how tight the labor market has become, to the extent that even the bargaining power of these lower paid workers is increasing. So as you know, Jeff, typically, lower skilled, lower paid workers are easier, the more easy to replace, and they therefore struggle to command those higher wages at most points in the economic cycle. We're seeing, as I said, the labor market tight to the extent where these workers are in short enough supply where they can benefit more because of all of these opportunities being afforded to them. So as I said, that was data from the Federal Reserve Bank of Atlanta. It's being reflected by federal data by the Labor Department, showing that these production and non-supervisory workers in the private sector saw wages grow 3.7% last month. That's ahead of the average of all employees of about 3.1%. One important thing to note is that while we're seeing hourly pay for these non-manager employees growing, the average hours worked per week has actually declined this past year in 2019. So that's a sign of employers still, offering higher wages to attract workers coming in the door, but then controlling their own labor costs by keeping the hours in check. And so we've seen that. We've seen a lot of anecdotes come out on the LinkedIn platform talking about that, about the higher wages being offered, but then the hours, the number of hours not keeping up. So it's just a sign of all of those things you mentioned. They're having more options. They're having more bargaining power when it comes to wages, when it comes to job options. Another important thing to note is that some of this is driven by what some economists call kind of an unnatural force, which is the rising of minimum wages across the country. So we have seen 29 states in the U.S. increase their minimum wages above the federal level of about $7.25 an hour, and 21 of those 29 states will have said they will increase that level again in 2020. So we're seeing some states like Washington State, for example, with minimum wages of as high as $13.50 an hour. So, the reason some economists worry about that is because, and they call it unnatural, is because that can, of course, reverse, and it's not driven by pure supply and demand of labor, of course. But I think it is a good sign, obviously, that some states are taking this seriously for all those reasons you mentioned, Jeff, that it's just, supporting their citizens, allowing them to budget more, to save more, and to have more optionality. And some of the anecdotes we're seeing in the conversation on the LinkedIn platform are extremely optimistic in terms of these lower paid workers getting, a feeling or an experience or a taste of this optionality I'm talking about and you're talking about, which is the ability to save, the ability to have more discretionary spending. And it's actually, again, this is generalization, but we're seeing it in several of the comments. We're seeing people inspired to continue, whether it's reskilling or seeking, higher paying jobs, or just supporting themselves in different ways in the job market. So that inspiration is certainly coming with higher wages. And actually, I was just reading an article this morning by Sonia Dreisler, who's quite active on LinkedIn, saying exactly what you're saying, which is when people talk about ESG, traditionally we've very often talked about the E and the G, the environmental and the governance, factors and attributes, but a lot less about those social attributes when it comes to scoring companies or ranking investments, et cetera. And we actually saw a bit of a flurry at the end of last year, at the end of 2019, of companies coming out and talking about how they're supporting employees and workers in new ways. You may have seen some of those kind of viral videos or stories of companies looking at their balance sheet and saying we can actually support a one-time bonus. I was just reading about a real estate company that took 10 million from the balance sheet, spread it across its 200 employees as a one-time bonus. And investors actually like that. I mean, investors generally are seeing that as a sign of an inspirational leadership, inspirational management, and a place where employees are motivated, and a place where, as we've talked about in this very tight labor market, both at the lower end and the higher end of the labor market, where employees need a reason or want a reason to stay at these companies and believe in their companies and believe in their leadership. And so we're seeing a lot more focus on that S factor, that social factor, about employees, about communities in which companies operate. That's really rising on the list of priorities among investors and corporate leaders.
Well, that's certainly good news. And on Tuesday, I sat down with Dan Klein of The Motley Fool to discuss a recent IRS notification that tax preparation services like Intuit and others can no longer hide their free tax preparation services on Google. Let's take a look.
So it's the very early part of tax season, and I would say that most people do not have their W-2s, their 1099s, their other forms. I'd say it's more common to start putting that together in late January. But some news came out that the government has actually made it easier, and it's rare to think of the government doing something that's pro-consumer. They've made it easier to find when tax companies, tax prep software, have free options. In all cases, there is some free option, but what companies have done, and I won't blame any specific one because it's been a widespread practice, is they haven't exactly been front and center with the free option. Now, they are no longer allowed to do anything that makes it hard for their free options to show up when you do a basic search on Google or other places. So most people cannot use a free option. You have to have a very basic tax return. Frankly, even if you do, it's worth paying the under $200 it will cost you to have the full audit check and audit defense and some of the other things you can get through the tax prep companies. But if you're young, if you have a very simple return and you want to file for free and use an electronic tax preparing service, you can do that, and now it will be easier to find. And it makes sense. So I've used the same company year after year, and my taxes have gotten progressively more complicated as I am a contract worker who works for largely one company, but also has significant other business interests that feed into my picture. I have some contractors that I pay. I have some short-term people that maybe build something for me digitally and then go away. I rent office space. I use part of my home as a home office, but a very fractional piece. A lot of my travel is taxable or deduction on my taxes. A small piece of my Disney membership or annual pass, because while I'm not going to pretend that 90% of what I do at Disney is business, 25% of it is and informs articles. So my tax piece is very complicated. And then I moved to Florida, where it actually got a little easier because we don't have a state income tax. So that's one less thing to worry about. But when my taxes were pretty simple, I used the same company. So now all of my historical data is there. We got identity thefted a few years ago, and it made it a lot easier in proving who I was to have all of the numbers from previous years at very easy disposal without having to get copies sent to me. It made filing the pre-report and refiling your taxes so they basically said, oh, these are the right ones, not this person who filed trying to get a refund and sort of stealing money. It's a lot easier. So even if you're very young and you could just do it in the back of an envelope, you really should do it electronically. It will prevent mistakes and it will make it easier for you going forward. Legitimate people you owe money to never ask you to pay an iTunes gift cards or Starbucks gift cards or anything else. The reality is, if you get a customer service call that doesn't seem 1,000% above board, you should hang up, find the actual customer service number for that company and call them and see if they have questions on your account. You'll get emails that will look like they're from your electricity company or your cable provider or whoever, and be aware that none of these companies will ever ask you for your account info in response to an email. Even generally, they will have a proper method of contacting you. They will not send you a, hey, could you please call me email. So be very skeptical and go online and find the right number, or look at your bill and find the right number and initiate. And what's the worst that happens? You call up and they say, no, we actually weren't looking for you. And you could say, okay, well, thank you, Verizon or Florida Public Power and Lighting or whoever it is, and just move on with your day. So when you say ever, I'll say yes.
Okay.
But the vast majority of government websites, which look like they were built in 1984 and probably were.
They probably were with COBOL.
Yeah, the government moves very, very slowly. Even, I pay my water bill at our Orlando house via a town interface, and it's super duper clunky, and like I could build something better myself pretty much. So yes, do I expect we'll go to facial recognition or eyeballs or DNA or who knows what? Yeah, 40 years from now. Do I think we'll have good government websites that can give us access to our information? Yeah, maybe in 10, 20 years. I expect the private world to move a lot faster than the government world.
When we come back, we'll talk about the most important financial move you can make in 2020. So stay tuned right here on BRN. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network. Welcome back. This week, with 2020 in mind, I sat down with the Motley Fool's Mari Backman to discuss the best financial move you can make. Let's take a look.
So there's a lot of different important moves you could make, like boosting your IRA or 401k, paying off debt. But I think the most important thing to do this year is build an emergency fund if you don't have one already. Okay, so here's the deal. If you don't have emergency savings, if you don't have some money in the bank to tackle unplanned bills or maybe a period of unemployment because you never know what might happen, you're basically going to be in a situation where you're stuck taking on more debt, or you face other unfortunate consequences when those scenarios come to be and you don't have that safety net of money in the bank to fall back on. So a lot of people ask me, well, if I have $47 in my savings account, but I also owe $2,000 on this credit card that's charging me 15% interest, why shouldn't I pay that off first? And my answer is, well, sure, you should try to pay it off as quickly as possible. But imagine you come into an extra $500 and instead of putting it in the bank, you use it to pay down that debt. That's great. But then what happens if a $500 unplanned bill lands in your lap the next week? then you might be looking at charging it on a card that's going to slap you with an 18% interest rate. Or even if you're paying, a similar interest rate, I mean, you're basically just right back to square one. And that assumes also that, you have the option to charge future expenses. People max out their credit limits, or in certain situations, like you might have no more money left on your credit card, you may be unable to get a loan, and you might risk falling behind on a mortgage payment if you don't have some money in the bank, and let's say your hours get cut at work, or maybe you even lose your job and it takes you a couple of months to find another one. So that's why I'm a firm believer that you need that safety net. And what I like to tell people is try to sock away at least 3 months of essential living expenses. So, if you typically spend $3,000 a month on living costs, but maybe $800 of that is your gym membership, your cable bill, the restaurant you like to go to every Friday night. You don't necessarily have to budget in for those things, because if you were really in that dire scenario of not having an income, you could always cut those things out. But you can't just not pay your mortgage. You need, or rent. You can't not have a place to live. You can't just say, all right, well, I won't make my car payment. Well, if your car gets repossessed, you have no way to get to work. You're stuck in that situation even longer. So it's essential living expenses that you're totaling, but I would say at least 3 months worth, and then honestly more like 6 months worth if maybe you own a home and a car and you've got kids and you're the sole breadwinner in your family. Personally, I like to have more like 9 months worth of expenses in my savings account, because the way I see it, I mean, I just have so many potential disasters in my life, Jeff. I don't like to think of it that way, right? But I'm a klutz. I could hurt myself. I have a 3-story home, and within that home, a number of things could go wrong on any given day. My husband and I, between the two of us, we each have a vehicle, so we own 2 vehicles. They're not new vehicles, so there's the potential for car repairs, for issues like that. Little kids who you never know when they, go running around and slam their head into something and need an ER visit. I mean, you hope it doesn't happen, but the way I see it, you always have to be prepared. And for me also, because I'm an independent contractor, I don't get vacation time through my job, through any of my jobs. So that if I need time off, let's say to, care for a child who, God forbid, breaks his leg, or, or if whatever, school's out for a period of time and I can't find childcare, so maybe my income takes a little dip. I mean, there's all these scenarios where, it never hurts to have extra money. So I like to be extra cautious. I don't know that the average person needs 9 months of living expenses, but those 3 months worth, definitely. We've had in my household, we've had what my husband and I jokingly through tears like to call $1,000 days, where we've had a couple of random days in the past number of years where we've had some unplanned bill or something pop up where it's been easily $1,000 in one day alone. Once it was an issue with our car, combined with 3 sick kids the very same day. So it was 3 last-minute urgent care doctor's appointments at like $40 or $50 a pop for copays. And that very same day, we had to do a major repair to my car. And then another time we had an issue with our home where a pipe burst in our basement, and they had to basically come in and refit a whole bunch of piping and whatnot. And that was easily $1,000. And I mean, it's a lot of money. I'm not going to lie. I might get a little down especially if it's a period where I've been really good about being a little more frugal, maybe haven't been spending as much on takeout, haven't really been doing much unnecessary shopping, and I'm doing so well, and then bam, a $600, household maintenance item or repair comes up. It can be depressing. I'll say though that having emergency savings for me makes it at least not stressful. I might get a little down, but I'm not sitting there going, well, how on earth am I going to pay this bill now? Or what other big changes am I going to have to make now to compensate, I mean, that's another reason why I need to have a higher level of emergency savings than most people, I think, because I don't enjoy stress. And maybe I don't even deal that well with stress. So by having that extra money in the bank, it takes the stress part out of the equation. And then what I do is, okay, I dip into that emergency fund, I pay whatever the bill is, and then I just work on trying to slowly but surely replenish it, which frankly, I'm usually free to take my time to do because I like to have 9 months worth of expenses in the bank, really knowing that I'm probably okay to have 6 months worth, or maybe a little less.
And in our last segment, I sat down with Bloomberg's Tucker Piner to discuss the Securities and Exchange Commission's recent proposal to change the definition of an accredited investor. Let's take a look.
I think it's great to take a step back and understand what does the words accredited investor mean and why is it important. And this is, anytime we talk about securities law, we're usually talking about the Securities Act of 1933. It's obviously been updated many times since then. And now we're talking about a proposal that's going to update the language that existed about 40 years ago. And the intention is obviously very good. The SEC wants to protect investors. They want to help you make sure you know what you're investing in. And the idea of being an accredited investor is the SEC permissioning you to be able to invest in certain securities that may not be registered in a normal exchange. This would fall under Regulation D of this act that we're talking about being updated. So what's important for Bloomberg is part of my job is to even decide if this is a hedge fund or private equity fund, what type of audience can view this information. So we need to have our compliance department approve every Bloomberg terminal customer as an accredited investor to even view data on Bloomberg. Without that designation, you'll get a restricted security message and you won't be able to see that. The proposed law is going to pretty drastically expand the types of investors that would be classified as accredited investors. What's interesting here and what's particularly important for your audience is the SEC used net worth, wealth, as a proxy for financial sophistication. And that's essentially what they're undoing here, basically saying that financial sophistication shouldn't matter that you have $1 million in assets or more, which is the current definition, or $200,000 in income. But it's more saying, do you have a Series 7? Do you have a master's degree from a financial institution? They haven't quite figured out what that idea of certification will mean, but the idea is proposing a new law that includes those people, those types of investors, people that are in your audience, to be able to invest in these private companies or these private funds that otherwise are not available to anyone like us in the marketplace. And it's particularly exciting, especially when you think about the amount of money that's in there. I mean, just in 2018 alone, there was $1.7 trillion of the assets that were raised went to these unregistered types of securities and funds, as opposed to 1.4 trillion, which are going to be in more of your registered securities. And again, the SEC's intentions here have always been good. It's just trying to protect the investors. And if you're an institutional investor, you can handle that risk. You're not going to be causing a run on the bank if all of a sudden that hedge fund dips down 30% and that's all of your wealth. It's designed to help protect those types of investors. But at the same time, if you work at one of these private funds, you often aren't even considered an accredited investor, even though you're the one making the decisions of the assets in that fund. So it's going to expand to include those types of investors and managers, and I think it's a great win for the industry. Now, the rule was announced December 18th, and it's going to enter a 60-day comment period. So we don't quite know what the final rule will look like, but it's I think a great step in the right direction. It's important for your audience to understand also that this whole idea of hedge fund and alternative investing, we should say, it's actually a legal requirement based on a fund's prospectus that they can only market their fund to an accredited investor. So it is going to massively change that due diligence process if you think about there are more eligible investors now as opposed to just this one pool that previously was available to you because they fit that definition of accredited investor. So it'll be interesting to see the types of institutions and more than anything, the SEC will call it a natural person. So these higher net worth individuals or people that's the certificate designation, they're now going to be eligible to invest in these private capital pools. And it's a new client potentially for a lot of the alternative funds that I work with. So it's going to be on the COO of these funds to do their due diligence and make sure that anyone fits this new definition. And it'll be on the investors portion to understand, am I investing in the right fund? Do I know what I'm investing in? And that's not going to change no matter what rules introduced. Every regulatory body, the intention is to help you understand what you're investing in. So, as we define better what an accredited investor is, or even as a fund has to write in their legal documents, I'm allowed to market to these types of people or these types of institutional investors, or even these geographies. I work with some funds that can't market to Finland, for example, because of certain regulatory rules. So it's important the U.S. is taking a great step in defining what they consider an accredited investor. That's going to add transparency into what that definition means, and then the investor community and the manager community can better know who each other are and hopefully have a better relationship. What's great about the European Union, and which Britain will find difficult, is there's this passporting idea that you can invest in different countries in the Union and face the same sort of regulatory requirements. That could potentially change. But I think overall, when we talk about defining accredited investor, I think the European Union and the Asian regulatory bodies will also catch up and try to be a little bit more clear, a little bit more inclusive of this accredited investor definition, because we're seeing so much capital going towards alternatives. Yes, it's decreasing on the hedge fund side, but it's increased 7% year over year on the private equity side. So alternative funds aren't going anywhere. Everyone's going to be looking for what fund can produce alpha. And obviously it's been a heck of a year for the market, but people are always looking for that manager who's going to weather them through that next storm. And who knows when that's around the corner. So I think that, the regulatory bodies here will step up and try to help investors, help define what accredited investor means. But, it's we still have a ways to go over here.
And that wraps up this episode of BRN Weekly. But we're not done for the week, because tomorrow we have our podcast, BRN Sunday, where I'm joined by members of the media, financial services, and academia to take a look at the latest news in retirement markets, technology, personal finance, and so much more. So hope you can join us. And until then, I'm Jeff Snyder. Keep on saving, and don't forget, roll with the changes.